Three Arrows Capital had $10 billion under management. By June 2022, it was gone, and it took BlockFi down with it. BlockFi entered the crypto market in 2017 with a simple promise: lend out customer crypto, earn interest, get rich. It sounded elegant. Thousands of retail investors deposited Bitcoin and Ethereum into BlockFi's vaults, trusting that the company understood risk. They were wrong. Behind the scenes, BlockFi had extended enormous loans to a single entity, Three Arrows Capital, or 3AC, a secretive hedge fund run by two men with almost no oversight. Three Arrows operated out of Singapore. Its founders, Su Zhu and Kyle Davies, made aggressive bets on crypto tokens, borrowed heavily, and kept their positions hidden from the public. BlockFi lent them hundreds of millions, Bitcoin, stablecoins, everything. The problem? BlockFi had no real collateral buffer. If 3AC's bets went wrong, BlockFi would collapse. And in 2022, they did go catastrophically wrong. When Bitcoin crashed below $20,000 in June, 3AC's leveraged positions imploded. The fund couldn't meet margin calls. On June 14th, 3AC admitted it was insolvent. BlockFi suddenly realized it had lent out over $680 million to a company with nothing left to give. The money was gone. Thousands of retail customers who thought their crypto was safe discovered their accounts were frozen. BlockFi's lending model had a fatal flaw: concentration risk. Instead of spreading loans across dozens of borrowers, they'd bet everything on 3AC. They also didn't demand rigorous due diligence. No one asked hard questions about how 3AC was actually using the money. The industry was too young, too eager. Everyone assumed the crypto boom would never stop. By November 2022, BlockFi filed for bankruptcy. The company that promised safety had locked away $14 billion in customer assets with no clear path to recovery. Creditors lined up. Customers waited. Some recovered pennies on the dollar. Others lost everything. The irony was sharp. People came to BlockFi to avoid the volatility of holding crypto directly. Instead, they got a different kind of risk: counterparty risk. The kind that kills lenders. What happened at BlockFi wasn't unique. It was a symptom. The entire crypto lending industry had built itself on leverage, secrecy, and the assumption that prices only go up. When that assumption broke, the whole structure collapsed like a house of cards. BlockFi was just the most visible casualty. The lesson isn't that crypto is bad. It's that lending without transparency, without diversification, without real risk management, that kills institutions. BlockFi failed because it made concentrated bets on a counterparty it didn't truly understand. And when that counterparty crumbled, there was nothing left to catch the fall. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next collapse. There's always another story buried in the wreckage. This video is for educational and informational purposes only and is not financial advice. Always do your own research.